Welcome back to Morning Markets on Friday, the 18th of August. Applications for US unemployment support were lower than expected last week. It's another example of the strength of the US labour market at this point in time. Stay tuned and we'll discuss the detail and what this means for your investments. Okay, so let's get into the detail first and then add context. First-time unemployment support applications were down 11,000 last week to 239,000. Those who are already claiming unemployment support and wish to continue ticked up 16,000 over the same period to 1.7 million. These are relatively low numbers when we think of the comparative labour force in the States of 167 million workers available. The unemployment rate at the end of July was 3.5%. There's the detail, there's the numbers behind this. But what are the implications of these numbers? Well, essentially it's demonstrating that the US labour market is very tight, it's very strong at this point in time. And it emphasises the challenge which the US Federal Reserve have on their hands to bring inflation at core PCE level down from current readings of 4.1 to their 2% target. So they've got work to do to bring inflation towards their target. And this is difficult when you've got the US consumer in such a strong position because essentially they're still out there spending. The challenge was acknowledged in the minutes from the July Federal Reserve meeting. The July Federal Reserve meeting, for context, resulted in a 0.25% increase in interest rates. These minutes were released on Wednesday, and essentially what they highlighted was, whilst they're going to be very focused on income and data, they're also very acutely aware that monetary policy is likely to going to have to be restrictive for a period of time until they see the inflation target in sight. If we look beyond this data and we look at some of the data which we see on the desk, we're seeing that some of the important components to that core inflation index, such as shelter and rental costs, we're starting to see a deceleration in terms of momentum. So keep an eye out for that data because we do believe it is adding a positive tailwind to help inflation move towards that target. What was the impact in terms of markets? Well, the expected level of interest rates and what we can expect 1 year out from now did change. The peak was unchanged at 5.5% in terms of what markets are expected for interest rates. But if we look 1 year out from now, the market has been expecting interest rates cuts to start to occur into the first part of next year. They were expecting 1 year from now that interest rates would be 1% lower. Essentially, they've taken one of those cuts out. So the expectation is 1 year from now, interest rates would be around 0.75% lower. What does it mean for markets? Well, at the front end, there was actually very limited change in terms of the bond yield. But if we look at longer dated bond yields, which are more sensitive to economic growth and inflation expectations, then we did see bond yields move up, which meant that the price change for longer dated bonds was slightly negative through the course of the week. So a lot of information coming out from the Federal Reserve. We're going to continue to see the debate evolve around inflation and economic growth and how they will respond. Stay tuned here on Morning Markets for all of the detail. Thank you for watching.